Good morning and welcome to today's Q&A call. I do have a few questions that we are going to start with, but today we will be cutting it a little short today because I am actually at an event and I need to go get some stuff set up. But I did want to make sure that I jumped in and helped anyone who needed help. We're going to start first with a rent versus own. So we're going to jump right into new client. Remember, the first thing with rent versus own, it is a simple switch of yes, they are renting. That's the first thing to note. So I'm just going to put in some information here. Janet is going to be our client. I, of course, would place Janet's phone number in here. Having that phone number makes sure that every time Janet gets that alert or every time I get the alert that Janet had looked at the presentation, I don't have to go back and look it up in my CRM in my phone. I can just click on that alert on the phone number and directly dial. And last thing, presentation name, rent versus own is what I'm going to place in here. Next, I like placing your new home. Again, it is about the mindset change. That's the only thing I'm going to place in that contact information. I want to make sure I did have it on rent. In the goals, I need to get my first home. Now remember, these goals are important because they do make sure that something happens in the presentation itself. So get my first home is what I want to have it on. Now on the assumptions, I'm going to put in rental information. How much is my client renting for? What is the rental increase? Monthly rental insurance. Now remember, this is going to be replaced with homeowner insurance. So it is a cost that once they're not moving, it will go away. And the last one, other monthly rental expense. Are they renting something that will go away once they go in and they're no longer renting? So what might some of those things be? Washer and dryer, pet deposit or monthly pet fees, carport, garage, extra storage, any of that they currently have, make sure you're placing in that number here because again, once they're not renting anymore, that fee goes away, so that is a cost of renting. Next, we're going to go to the next page. If you want to see DTI, you can place this in there. Same with the credit status. The client does not see this information. Nothing here is required. It is all based on, do you need the information or not? If you don't need the information, please don't waste your time and fill it in. If you need the information, maybe you haven't pulled credit and you're going off of what they're telling you, fill this information in so then you can see that DTI and say, yes, they're going to qualify or not. Same with savings and balance. If you're concerned that they might not have enough reserves at closing, this is a good thing to fill in. But if you don't need it, skip it. We are going to go a little bit into this. I'm going to put a single person in there, $12,000. Now, where did I get that from? If you click over here, or if it's already open, there is a standard deduction cheat sheet. After you use it a while, you'll have them memorized like I do. The average person at $12,000 at $65,000 is 22% tax bracket. I know that again just from working in it. If I did not know this, I could click onto that find tax bracket, put in just the few items that I need here, click on that calculate, and it gives me an average tax bracket for their salary range. I'm also going to leave it on single. If they did use the MCC credit, I could put what percentage, 2%, and the maximum 2,000 credit in here. The next page is again completely for you. I would only use it if I have not already pre-qualified my client. Otherwise, I would go from that affordability right into my first product. More likely rent versus own, probably a first-time home buyer, so I'm going to go ahead and start with that FHA loan. If you have product templates, this is going to be the fastest way to drop it in is by using a product template. I'm going to do it from scratch for those of you who do not have those product templates. Adding my upfront FHA premium. My purchase price, I'm going to say $279. Down payment, 3.5%. Interest rate, I'm going to say 3.675. a 360 term for 30 years. Going to my next page, closing cost details. Now here, if you do not have these templates built in, if you haven't built yourself templates, please build yourself templates. This becomes a point of frustration. So having these templates in here so I can just drop in my template makes it super easy for me, where if I didn't have my template in there, I would have to go in there and I would have to fill this out every time. Let's say you've had a previous client that you've already built in this information. You can go into that previous client, click Save As, and save that template as your FHA template. Then you're going to have a template to start with. All you do is click on OK, and then you'll find that template up here in your template list. Once you choose your template, make any adjustments on here that you might need to make. I'm going to say lender's title, $1,700. I'm going to say owner's title insurance, $654. Once I'm happy with everything in here, I'm going to apply it to the loan. If I did have them paying points or lender credit, I could show it here. Points would be a positive integer. Lender credit is a negative integer. 15 days of prepaid interest. Now here is where I can see that DTI. So that product one, we are in that safe range. I could actually increase that loan amount if I needed to. I'm going to keep going through, adding my upfront MI. I'm going to add it to my loan just because that's my normal practice. If the client did not want to do that, we do not want to see blue in the box. Finally, hazard insurance and property tax. I'm just going to use factors here because I don't have a home yet. I could use dollar amounts as well. I'm going to go down to my mortgage insurance, 0.85. MI cutoff is 0 because there is no MI cutoff. It's at 360 months. And finally, adding my hazard insurance and property tax reserves. So I just build out that full product. At the end of the product, there is the add another product. I'm going to do a 5% conventional. Now, why do I choose to do a 5% conventional? Because if I add the down payment for the FHA plus the upfront premium, it is almost equal to 5%. So I'm comparing apples to apples here. Now, instead of me building from scratch, I'm going to copy it from my FHA and click on OK. Now all I need to do is make the little adjustments. There is no upfront premium. My down payment amount is now 5%. I'm going to say my interest rate is 3.75. Closing cost, if there is a difference. I'm in California. My difference is there is pet inspection on FHA. There's not pet inspection on a conventional. That's my only difference. So I would go in here and make that change and reapply it to the loan. My prepaid days of interest would stay the same, as well as everything on my monthly page except for my MI, which I would come in, adjust it for my client. 78 months, I would adjust my minimum months to whatever it is at your company, normally 120 or 24. And then I have my second product. So does anyone want to see me build out a third product? I can build out a third product. If I did, what I would show is an 8515. So does anyone want to see an 8515? You can raise your hand as well if you do want to see an 8515. Okay, let's go ahead and show that one as our next product. So 80-15-5. Now, again, I don't want to start from scratch, so I am going to copy it from the one that's the closest, my 5% conventional, and click on OK. And I'm going to make my adjustments. Down payment is going to be the CLTV, everything that's going in there, 20%. You have your little cheat sheet over here. So this is where we're going to look for it to be 95%. So that's going to be where your cheat sheet is. Make sure that you're watching that, and that's going to also allow you to know, did you put it in correctly? While I'm sitting here talking, I'm going to quickly calculate what my 15% would be. So give me one moment. $41,850, just so I remember. So then I would adjust. I'm going to say the interest rate's going to go down. Going to my next page, my closing costs would remain the same, as would everything on this page, except for now I'm not going to have MI because I'm going to have that second loan. And here at the bottom it says, does this product have a second lien? Yes, it does. Now when I go into the second lien product, I'm going to be able to place in the information. So here I'm going to have that $41,850, which is 15%. My interest rate on this loan, my term, I'm going to say it's 240 months, and I'm going to say my first 10 years is interest only. If I did have a balloon payment, I could add that it is a balloon payment at that certain period. I could also adjust it here to an ARM loan. Now being rolled out soon, what you will find is a true HELOC in here. So at this point, if you do have a HELOC as that second, you do have to manipulate that ARM loan because it is configured a little different than an ARM. Moving on over, if I do have cost, I'm going to say there's $150 subordination fee. That's the only cost that I have. Second loan is all built out. How do I know that it's right? My LTV over here now is showing 95%. Any questions on that? And if you do have a mic, you're more than welcome to raise your hand. I'm going to put everyone's hands down. So if you do have a question, you can raise your hands. So Robert, I'm going to allow you to talk. You do need to unmute yourself. Good morning, Robert.
Morning.
How are you?
How did you come up with, how did that 95% populate on an 85, 15, 5? How did that happen?
Okay, so what I did was, on the very beginning, this is that 20% down. I got to go back further. And one more. You have to place in the full 20% here because you're going to take 15% of this as that second loan.
Correct.
That's going to leave you with 95% down or 95% LTV.
I'm just wondering how, because I saw you put the 20% and then it became 95 on that side. So I was wondering how.
Yeah, it's because as soon as I added that second loan of 15%,
yeah,
it then shows it here.
Okay,
so you just always have to remember, start with your CLTV.
Okay, thank you.
You're welcome. Any other questions? Okay, looks like we're good. I'm going to go ahead and move towards the end. So into our analysis page, setting this up based on the client. Now here's where it's different, rent versus principal paid. Because I did show tax benefit, I can click on tax benefit and use it. I can also click here on tax benefit analysis. So does anyone want me to dive into the tax benefit? Again, you can just raise your hand if you do want me to dive into tax benefit for you. So let's go ahead and talk about that tax benefit. I'm going to increase my home price just so I do have a tax benefit on here. So let me come in here really quick and make that adjustment. I'm going to also adjust my 5%. I'm not going to adjust my 80, 15. Actually, what amount did I use? That's the question. 320. Okay, so now that I've adjusted it, now I'm going to see a tax benefit. Now you might say there is a tax benefit showing, or oops, I didn't adjust it enough. There's a tax benefit showing for the rent. The rent tax benefit is that standard deduction. So because we have a standard deduction in there, that's why the rent is showing that there is a tax benefit. So I'm going to adjust this one more time. Let's get a tax benefit. I'm just going to put 400. Now, tax benefit comes into play as the interest of the home divided by 12 multiplied times your tax percentage. In this sample, we use 22%. So that is how we come up with the amount of the tax benefit. Again, total interest of the home divided by 12 multiplied times their tax bracket. The tax benefit here on rent is standard deduction divided by 12 multiplied times their tax bracket. So that's where we get these amounts. Now you can see the rent and the 8015 5 is both the same standard deduction amount. This means the interest on the home divided by 12 multiplied times 22 is less than the standard deduction, so the standard deduction is the one that comes into play. So if you were to see the 13,200 straight across the board, I would do one of two things. I would either only show rent versus principal paid here in this box, and I would leave that in the actual presentation, and I'm going to open up the presentation so we can look at it. So I would leave it here because it would still show here in this line that the tax benefit is the same. Why would I leave it? If you are comfortable talking to the fact that you're not a tax accountant and you want to start working with financial advisors, here is a way to drop in the financial advisor conversation. So, based on the home that you're buying, the interest credit for your tax benefit is less than the standard deduction. However, I am not a tax accountant and cannot talk to your full tax picture. For this reason, can we bring in your tax accountant or your financial advisor to have a three-way conversation to see how it's really going to impact you? Now, 7 out of 10 people are going to say, I don't have a financial advisor or tax accountant. Fabulous, because I have a great one that I would be happy to refer you to. No obligation whatsoever, but they can look at the big picture and then be able to decide it if you want to send them your tax forms, and then we can have a conversation. So that is how you can bring in tax accountants to be able to have referrals to them, as well as to be able to get referrals to them is by pulling them into this conversation. After I have that conversation with the client, the three-way conversation, I am then going to talk to that person one-on-one, the tax or the financial advisor, tax professional, and I'm going to say, you know what, I'd love to talk to you about how we can refer to each other. Is there a time that we can have that conversation? Probably an email or a text to start with. And once they say yes, I'm going to show them an actual breakdown that has the reinvestment strategy as well. So I can really start diving in and showing them how I can help their clients be able to use their financial services as well as their tax services. But in this case, again, if I don't want to show it and I don't want to have that conversation, I'm going to leave it on rent versus principal paid in this window. So any questions on that conversation? Now remember, as interest rates go down, you're going to see less of a tax benefit on the purchases because it is based on how much the interest is then on the home. So it's interest divided by 12 multiplied times their tax bracket. So here in this window, you can change it up as well, total principal paid, net worth, or interest in MI. I like showing net worth because, of course, with renting, there is no value. There is no net worth here. So the others you can show total principal paid, rent is unrecoverable, principal goes into equity, and this one is showing unrecoverable cost times and unrecoverable cost. So I'm going to leave this on net worth, and on this one I'm going to go ahead and show rent versus tax benefit. Actually, tax benefit analysis is my favorite. And I'm going to click next so it updates it over here. So on this presentation, The main difference is this upper right-hand corner. So if you're accustomed to the total cost analysis, this upper right-hand corner does not show the same information on a rent versus own. What it is showing is unrecoverable cost, the true cost of home ownership. So how do we come up with the true cost of home ownership? We are taking the total payment. This is what is normally compared on the TCA. So we're taking that total payment. We are then subtracting any money that goes back into the client's pocket. So I would subtract their tax benefit and their principal paid. That is where I get that net monthly payment. So again, I'm going to go through it really quick. Total payment, less money that goes back into their pocket, tax benefit and principal paid, gives you the real cost of home ownership that you can show over here to the client. Any questions on that? And again, if you do have a question and you have a mic, feel free to raise your hand. That is the main difference in this presentation, is that we are really showing the cost of renting versus the cost of home ownership. You can see because of that tax benefit, that is subtracted on the rent side too because of the large standard deduction. You have to remember that. Now, if I did not include tax benefit, it would just not have it here. So it would take that tax benefit out. We'll go back really quick and just remove it. So it's in the affordability section. All I have to do to remove it is I remove my standard deduction and I remove the tax bracket. It's then going to take it off my presentation, and then I don't have to talk to tax bracket and I don't have to talk to the tax benefit. And I'm at a hotel, so internet's a little slow here. So the other windows, tax benefit analysis I'm showing here because I'm moving tax benefit. I'm going to switch this over to now show rent versus principal paid. When there's no tax benefit, rent versus principal paid is what you always want to show in this window. I'm going to do a cheat. I'm going to reopen it. Just because my internet's a little slow here, it's not updating. It's still not updating. So you get the picture. The last thing is, there we go. Nope, still showing it. So more information, nothing new is in these windows. The only thing you have to remember is your second. Your second is not broke out in this summary area. So in this summary area, it is having the first and the second, but you do see the words blended rate and blended APR. If you want to see the payment stream of that second, click on the payment stream, and there is a loan to option up here that you can switch to that's going to show you that payment. So the first 120 payments is $179, then at month 1 or 119, and then it goes up. So you'll be able to show that payment. More information here, closing costs are normal, fee details. Now remember I said on the 5% conventional and the FHA, your upfront MI plus your down payment is almost the same as a 5% down. That is why I choose to show the 5% down. If the client is driven by the cash to close, if this is a more significant number to them than their actual payment amount, then I am going to go with a 3% versus a 5%, because that 3% is going to drop their cash to close. So in here, I rolled this into the loan amount. If I didn't roll this into the loan amount, this would be a little over $27,000 as well. So that's why you're not seeing it here as the same amount. Any other questions on the rent versus own? Yes, Robert?
How did you come up with the 22% tax bracket? I didn't see that. I kind of got here a little bit late prior to that.
So on that tax bracket, when you go into the affordability, let me close this window, there is actually a fine tax bracket here where you can go in, you can put in their total income, how they're filing, if they're filing single, married. Once you click calculate, it'll give you the tax bracket right here.
Thank you.
Yep. Any other questions? Yep.
Is there an area where you can put property appreciation over time within this particular one?
Yeah, in the analysis area, that property appreciation is the top one of the analysis area.
Was that already included in the one you just did right now?
Yep, it is. It's included in the net worth down here at the bottom.
Okay, thank you.
The other thing that I will mention with that is the MI on the 5% down. If you click adjust MI with appreciation, you'll be able to go down to the adjust reinvestment strategy. And sorry, my internet is not very great here. Clicking on this, it'll then tell me when it's actually going to drop off that MI. So at the top of there, you'll see that MI drop off. Do you have another question, Robert?
No, I'm sorry. I didn't realize it was still clicked on there.
That's all right. How about the standard deduction? Where did you get that? Okay, standard deduction, remember when you were on that affordability page, or yeah, if you click over here, your standard deduction is a cheat sheet. Standard deduction is really easy to remember. It's 12, 18, and 24. 12 for single, 18 for head of household, 24 for married couple. So single person is 12. You get 1/3 more for your head of household, and it's doubled for married. But it is in there as a cheat sheet. Let's see if we can get that to pop up for my adjust reinvestment strategy. Yeah, my internet here is not supported at all. Okay, looks like it's not going to pop up, but if you do dive into that adjust reinvestment strategy, at the top of there, it does show the MI drop-off months. So by clicking this little button, it takes into consideration the property appreciation. If this is unclicked, that property appreciation is not taken in consideration. So I like, when I'm doing that 5% down, I like using that little button here so I can really see based on the appreciation expectations when it's going to drop off. And then I'll talk to the client about refinancing at that time, or what are the choices that they have based on the interest rate that they have. Okay, I'm going to go back to the beginning. Any other questions on rent versus own before I move to the next question? Nope. And Joe, I'm going to quickly answer your question. So when you're doing a HELOC and a second mortgage, so I'm going to go ahead and go into new client, and Joe is doing a refinance. And I'm just going to go into the goal. On a refinance, I like clicking on other. Or if you want that HELOC to automatically be added to your first, and that's how you're doing it, you can put pay off debt and put the amount of your HELOC right here. So let's say I'm doing one that has a $120,000 HELOC. I can put that there, and then when I go into my product one, it's going to add it to my loan amount. Now in my assumptions, it's going to ask me current information. So what does my home appraise at today? I'm going to say 230. I'm then going to go in and place in the information about the current loan. So when was the first payment date? Now you'll see I clicked on the arrow. I clicked on the arrow to open up the months. Now when I scan up, I can go year by year. I don't have to go in, or I can just type it in. Whatever is easiest for you. So my first payment, and I'm going to say my original loan amount was $213. Interest rate, it was a 30-year. Here's my remaining balance. Then I'm going to go in, I'm going to add the actual hazard insurance, not a percentage, because if I use a percentage, whoops, if I use a percentage, what's going to happen is when I copy it over, it's going to change what their hazard and their property tax is. And we don't want to do that. We want it to stay the same if it stays the same in your state. Mortgage insurance, if they did have it originally, I could add that as well. Now I can show, does this property have a second? Again, I'm going to put in the actual information based on that second. So I'm going to say, give it a random date. And I'm going to have to guess here to try to come up with the 120 amount. So I'm really close. We're going to increase this just a little. Okay, so here's my remaining balance. Whoops, that's about 220. We want 120. So there's my remaining balance. So now, because I placed in that goal that that payoff amount is here, now when I come over here and copy it from another product, I'm going to copy the current, and you'll see that current one here. And then when I switch it to, yes, it is a refi, it's going to automatically add it for me. So any questions on that, Joe? You're welcome. That's the way to fix it. Now, what you do need to realize is when you copied it, that second loan is turned on over here and showing, so you'll have to turn that loan off. So remember to turn that second loan off. Any other questions that we have today? I'm getting close to when I have to jump off, but if someone has something they need to see, I will show you what you need. So I am going to give you guys a quick playlist. Just in case anyone has something that they do want to see. Is there a way to adjust the timeline? Can you explain what you mean by timeline for me, Christopher? I'm assuming the times, right now you have selected the benefit. Yes, and I'll show you that really quick. I'm just going to get this playlist and copy it really quick. Okay, so on the timeline, I'm going to go back into that rent versus own. When you go into the analysis area, short-term analysis is the one that says tax benefit analysis. Long-term is the one that says net worth. Even if you are in a total cost analysis, and I'm just going to dive into a normal purchase on a TCA, short-term is the savings over 60 months. Long-term is that interest in MI paid. If the client is in the presentation, we're going to open this presentation up really quick. I'm going to share the link with you. So I'm dropping that link into the chat box. If you want to click on that link, when I see someone go into it, my views up here are going to change. So if anyone wants to click on it, there we go. I have 2 viewers. Now, his question is, can I change it live? Absolutely. So if I go back in here into my analysis window, and let's say all of a sudden they want to see 48 months and they want to see 8 years. The trigger is that next button. Clicking on that next button is going to change it for the client. So you can change anything when the client is in it. Let's say they decided on a different loan amount. They found a house and they want to see a different loan amount. I can go in here and adjust the loan amount for them so they can see the new loan amount as well. So remember, it is live. The whole time it is a live link. So you can only show these two at a time, but you can adjust them and go back and forth for the client. Does that make sense, Christopher? And Janet, you can get a copy of this, but I will not remember who asked for copies. So if you want a copy, email me, tina@mortgagecoach.com. And then I will send you over a copy of this. I'm also going to give you this playlist. This is a great playlist because it is segmented into actual to-the-point presentations. So if you have cost of waiting, you want to see cost of waiting, it breaks it down. So whatever you want to see, it'll break it down for you and you'll be able to go right into it. Okay, if there's no other questions, I am going to go ahead and hop off. So I'll give it 1 minute. And if you do have a question, raise your hand so I don't jump off while you're typing. If you do want a copy, email tina@mortgagecoach.com and I will send you over a copy as soon as I get it uploaded. It might take a while. It might not even be till tomorrow morning because I do have to go jump into an event. So thank you all and have a fabulous weekend. Bye-bye.